Ready to pass the CPA exam faster? Visit cpapass.ai. Today, Unrealized Gains Trap, How to Prepare AFS and Trading Journal Entries. Examiners love to trick students using the blind ownership percentage rule. Many candidates assume that owning exactly 20% of a company's stock automatically requires the equity method. This is a classic trap. In reality, the 20% threshold is merely a rebuttable presumption, not an absolute rule. The true determining factor is whether the investor exerts significant influence over the investee. If significant influence is absent despite a 25% stake or present with a 15% stake, the accounting treatment changes completely. We must analyze the actual facts of the scenario, not just the percentage. Let's establish the core framework comparing these two methods. When an investor owns less than 20% of a company and lacks significant influence, they use the fair value method, often referred to as the cost method, if fair value is not readily determinable. Under this method, the investment is recorded at cost and adjusted to market value, with unrealized gains or losses hitting the income statement. Conversely, when ownership is between 20 and 50%, significant influence is presumed, triggering the equity method. Here we do not adjust the asset to fair value. Instead, we adjust the investment balance to reflect our share of the investee's economic activities. To master the equity method, think of the investment as a corporate bank account. When the investee earns net income, they are adding money to that account. Consequently, we increase our investment asset balance by our percentage share of their earnings, recognizing investment revenue. Conversely, when the investee pays a dividend, they are distributing cash out of that account to us. This cash receipt is not new revenue. It is simply a withdrawal from our investment account. Therefore, under the equity method, dividends received decrease the investment asset balance. This bank account analogy prevents the common mistake of treating equity dividends as income. Let's look at a worked example under the cost or fair value method. Suppose we own 10% of a company and receive a $10,000 dividend. Because we lack significant influence, we apply the fair value method. The journal entry is a debit to cash for $10,000 and a credit to dividend revenue for $10,000. This dividend directly increases our net income on the income statement. The trap here is assuming all dividends are treated this way. Under the cost method, dividends are indeed recognized as income, but as we will see next, the equity method treats them completely differently. Now let's examine the exact same $10,000 dividend under the equity method, assuming 30% ownership. When the investee pays us this dividend, it is a return of capital, not revenue. Our journal entry is a debit to cash for $10,000 and a credit to the investment asset account for $10,000. Notice that no revenue is recorded. This directly reduces our investment carrying value on the balance sheet. This dividend income confusion is the most heavily tested trap on the FAIR exam. Always identify the accounting method before recording any dividend transactions to avoid this error. Now, to summarize, always remember the die mnemonic for the equity method. Dividends decrease the investment, investee income increases the investment, and the initial entry is recorded at cost. Never rely blindly on ownership percentages. Look for indicators of significant influence, such as representation on the board of directors. Be prepared for questions that ask for the final investment balance versus the impact on the current year's income statement. To master these concepts and practice realistic task-based simulations, head over to cpapass.ai to work through our comprehensive test bank. Keeping these distinctions clear will ensure you avoid the examiner's traps and secure those valuable points on your exam.